Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, member SIPC. My favorite co-host is with me, Patricia Dunn. Pat, good to see you.
Good to see you.
Pat's with Merrill Lynch, also a member of SIPC. And our special guest is Eric Fuhrman, Chief Planning Officer and a certified financial planner at Key Financial, Inc. It's going to be a good show. Stick with us. Okay, Pat, let's get started by discussing what's in the news lately about, is an index the way you should invest, or should you use a mutual fund manager who picks certain stocks in certain sectors?
I am more of a managed money approach. So the mutual funds where you've got active management is where I feel more comfortable. That's not to say that index investing is bad. I think index investing is excellent for your core holdings, where you want to get a well-diversified portfolio, but all you're trying to do is get an S&P-like return, but do so with less risk.
Okay.
They're very good as the anchor of a portfolio or for inexperienced investors. It's a very good way for the general public to get involved. But if you really want to get ahead, you've got to use individually managed products, be it a mutual fund or an investment strategy.
Okay, and our viewer question will address this again. So we'll move on to our next subject. Is it tough to allocate as your clients are getting older now and interest rates are low and U.S. stocks are forward PE of 18 or so, and we want to remind our viewers and listeners, don't market time based on our show because it'll be aired at a later time than today. But is it really tough to help your clients who need income and with the asset allocation, and they're nervous and they say, I don't want much risk, but I want to have a lot of income? How do you handle that?
Well, that's a very interesting question that you and I deal with every single day. Because the natural reaction of the older client is, give me more bonds, because in my mind, bonds are safer. And you and I both know that that's not the case in a rising interest rate environment. So is it tough? I don't know that it's tough. You really have to have a more in-depth conversation. And typically I do more core holdings with an older client and a lot in the way of dividend plays. But I have to go into real explanations of how a portfolio reacts, how a bond portfolio reacts in a rising interest rate environment, because it's not intuitive to the older client.
And it's tough for a lot of clients who think they have enough to retire, but they really don't.
Right.
And so then the question is, do you want to be aggressive and take a chance where you could really get hurt? Or do you want to cut back on your spending? It's an unpleasant conversation, but it's something you have to have up front with a client, right?
Exactly, and it's best done with a professional rather than on their own.
Sure it is. Especially people who've gotten themselves into that kind of a situation without realizing it, because maybe when they were thinking about retiring, they expected a 6% return on their money, and that's unrealistic at this point, right?
Right.
Okay, well, the Federal Reserve is starting to raise short-term interest rates. Interestingly enough, longer-term interest rates are coming down, and people thought if inflation was coming back, both short-term and long-term rates would go up. What do you think's going on? What's the market telling us?
I think what it's telling us is that interest rates going up are not the whole story. I wonder if the Fed isn't pausing a bit here and selling some of the inventory they have. And as they sell off that inventory, that could be affecting the long-term rates. So I do not see inflation ramping up in any way. How do you feel about it?
Well, I agree with you. We'll know whether inflation's coming back by looking at gold and the dollar and also the long-term rates. But right now, the long-term rates are telling us that we can feel assured that the Fed is not doing a lot of damage in terms of preventing inflation. But the question is, as the long-term rates drop, are they slowing the economy down, and do they need to rethink how many rate hikes they're going to do in 2017 and beyond?
It'll be an interesting year.
It sure will. All right, well, as I just mentioned, gold is going to tell us a story about inflation. I always talk about the three vigilantes, which is the dollar and gold, and long-term interest rates. And right now, I'm not worried about gold going up, but it will be probably the first one that will set the alarm if inflation is coming back. Do you see it that way?
I agree with you 100%. I do not see gold as gold and firearms are like doomsday scenarios.
Yeah.
And I'm not promoting the purchase of gold at this time. There are some people who feel they absolutely have to have it, and dabble in it, but don't do it in a big way, because I don't see it as adding value to a portfolio right now.
I agree. When a client is insisting on buying gold, I say put a few percent, 2, 3, 4% in gold, and hope you never make a nickel.
Exactly.
On it. Because if gold's not going up, the other 96% of your portfolio is probably acting pretty well, because inflation's one of the real enemies of the stock market.
Exactly.
Okay, well, we have worldwide events that are keeping people nervous. Everybody's focused on Washington, you know, Syria, and who knows by the time this show is aired what will be going on in North Korea, Syria, Iran. But a lot of people are focused on that, and it makes them hesitant to want to be in the market. Do you think those type of events should be scaring people away from the stock market?
Actually, I don't. Because what should scare people away from the stock market is when there's general euphoria. And as long as there are these kinds of overshadowing problems, you're not going to have euphoria. And markets die on euphoria. So as long as it's climbing a wall of worry, stock markets tend to do well.
I agree with that. I believe that, and Sir John Templeton used to say it, and he was a brilliant investor.
Absolutely.
Bull markets end in euphoria, and I keep checking with my clients, and I haven't seen too many euphoric ones yet.
I haven't either.
Okay, fair enough. Okay, so do you invest for the long run and not worry about when there's going to be a bear market? Or if you get to price-to-earnings ratios in the U.S. of 22, would you be tempted to sell at that time? How do you handle those unusual situations where things seem out of whack?
Well, that's a very good question. I am a long-term investor, and even during bear markets, I encourage people to stay in, to ride it through, because we never know when they're going to end, and to miss the beginning of the next ride up is critical to building net worth. Now, contrary to that, yes, I do get very nervous when euphoria abounds and people are banging down the doors to open up accounts.
Sure. And
then I would raise more cash. As for the PE ratios, you could say PE ratios are high now at 18, 19%. But the interesting thing is that the S&P 500 is dominated by technology and healthcare stocks. And technology and healthcare stocks generally carry higher PEs. So is the market at a higher PE, or is the S&P at a higher PE?
And is the E going to go up to make it look pretty good in another year or two? And they're starting to see some revised estimates on earnings coming out of S&P from a lot of different smart analysts. So we'll see which way that goes. I want to just briefly talk about, quote, crash-proof retirement. I see these ads on television. Is there really a free lunch out there where people can just know they're going to make 6% or some number and not have a care in the world? How does that work?
Charlie, I've been doing this for 41 years. I know you've been doing it for several decades as well. There is no free lunch.
Yeah.
And if something is too good to be true, generally it is.
Fair enough. And I just want to remind our viewers and listeners that if they hear something like this and it looks pretty good, go to another professional, get a second opinion, make sure that you understand how this black box is supposed to work.
Exactly.
And then you make your decision. But be careful when someone's telling you that there's no risk and you can't possibly lose money and we're going to give you 6% a year or 4.5%. Or whatever the number is. Okay, I've got that off my chest. So let's move on. Does the worldwide instability make you think that there are certain sectors, for example, the defense stocks, that maybe you should be investing in right now? Or do you just kind of try to keep a same ratio how much is in different sectors and just rebalance from time to time? Or do you try to react to these news events like maybe North Korea will be launching a missile?
Well, the interesting thing is I don't run a transaction business. I run an investment strategy business. And so the research analysts will overweight and underweight the different sectors. But as for if I had a perfect sector right now, I think the one sector that's likely to do well, regardless of what scenario comes out of Washington, are actually the financials.
Mm-hmm.
I think they're in a very good position. They've been beaten up unmercifully, and it's time for them to gain some strength. But generally, I'll stick with overweighting and underweighting.
Okay, well, I have a question here. Tim Lyons of Philadelphia says, artificial intelligence is popular, but is it a good investment, and what companies are the leaders? Wow, what a tough question to answer.
And I think actually, rather than artificial intelligence, I think that, Tim, you may be thinking in terms of alternative investments, which is another interpretation of AI. Now, AI, alternative investments are not for the faint of heart. Alternative investments are a diversifying technique for very large portfolios, typically over $1 million portfolio. And they're looking for assets that are not correlated to the S&P 500. So that what the market's doing is not necessarily what the alternative investments are doing. But that being said, I did say it's not for the faint of heart. These investments typically require high minimum investments. They're typically not very liquid, like it's easy to get in, but it may take some time to get out of them. There are also some tax ramifications because they typically produce a K-1, which could mean you get delayed in filing your income taxes.
After your taxes are mailed in, you find out there's a K-1.
There's a K-1. It showed up in May, and you've got to refile your taxes. And as a result of all of these, quote, problems with alternative investments, recently there have been mutual funds that invest in alternative investments and even exchange-traded funds, ETFs. But it's not for the faint of heart. And I would definitely not try to do this on your own, Tim. I would consult a professional before dabbling in that market.
Good. Well, thanks for giving him an excellent answer. And I don't know if Tim meant artificial intelligence or alternate investments, but in a recent show we answered the other question. So if they find us on the website, they can get their answer either way.
That's right.
Okay, if you have a question, please pay attention for the next 60 seconds, and we'll show you how to send your question in to us.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, now that you know how to send in a question, we're going to get to our special guest, Eric Fuhrman, Chief Planning Officer, Key Financial, and a certified financial planner. Thanks for being here, Eric. We really appreciate you visiting here.
Charlie and Pat, thank you so much. It's a delight to be here and honored to be here at this table with two industry veterans.
To get us started, just tell us briefly about your firm.
So Key Financial is, we focus on holistic, comprehensive financial planning. You know, our goal is really to, use a goals-based approach where we sit down with investors and really get to know all the different facets of their lives, whether it be their needs from estate planning, income tax. The investment portion is obviously critical to the business. But what's most important is our goal is to really establish a foundation by developing a comprehensive financial plan, and then really using that as a means to hopefully support and realize the most important goals that they've articulated to us throughout our process.
And I imagine that initial meeting is very helpful. Sometimes people think they're not risk averse, but it's a good idea to find out if they really are in that first meeting, right?
Well, Charlie, that's such a great question, and it's interesting as time goes on, but there's so many elements to risk, not only what we would refer to as risk tolerance, but also the concept of risk capacity, the ability to take risk. You can always have a mismatch where somebody might be extraordinarily aggressive in their posture for investments, but they don't really have the means or the capacity to take the risk. So the part that I think that we really love about our jobs is facilitating the role of being an educator to help align some of these mismatches and try and do the best to really create a harmonized approach that optimizes all the different facets of their financial affairs.
Okay, to get started in specific questions, I know that tax cuts are a big issue in the lives of Americans as they try to figure out what's going to be the 2017-2018 tax rate. How do you address that?
Well, who doesn't like to talk about taxes, right? It's a terribly interesting subject. Right. But I think, a lot of the public discourse so far has really been focused on, kind of business taxes and individual income taxes. How do we bring the rates down? And this idea of simplification. So this is kind of executed by going from our present 7, marginal tax brackets down to 3. But I think there's a lot of other elements to taxes, if anybody that's ever read through page 1 and 2 of a 1040, that would realize that there's other elements here that we need to consider as well. So right now there's really, a proposal by the president and also one from the House Republicans. But both of them contain kind of vastly different ideas about some of the elements of the tax code. So just to give you a quick rundown of 3 of them. So capital gains, for example. Right now, if you're in the 15% bracket, people enjoy a 0% tax rate on qualified dividends and capital gains. Under Trump's plan, he largely maintains that capital gain tax regime as it stands. Now, part of his goal was to repeal that nagging 3.8% net investment tax from the Affordable Care Act.
We have to bring you back for another show just to discuss that part.
Yeah, yeah, exactly. But he largely keeps it intact. Now, the House Republicans have a vastly different idea, where the proposal is to exempt up to 50% of investment income, qualified dividends, and capital gains, and then the excess above that, the other 50%, would be just subject to whatever your marginal tax rate would be. So in an extreme example where the proposal is for a 33% rate at the top, your effective capital gains rate would be about 16.5. So vastly different there. Exemptions is another big issue. So Trump's idea is to elevate the standard deduction, which would simplify the process, because that would mean millions of people no longer have to itemize.
Right.
But it's not a drastic tax cut, because there is also a proposal to eliminate personal exemptions. The exemptions you would get for a husband and wife and any dependent children. So it's not as great as it first seems. Now, the House Republican bill is quite a bit different than that. Their approach is to actually eliminate as many itemized deductions as possible and really just preserve the deduction for home mortgage interest and also charitable deductions. So ultimately we'll see which one comes out of that. And I think the final piece is the tax rates on trusts. So largely trusts mirror the income tax system for individual income taxes in terms of these various brackets. But obviously the income that's subjected to those brackets is far lower, so $12,500,
yeah.
And you're paying a 39.6% rate, so it's very punitive. But I would be hard-pressed to believe that they would have a dramatic overhaul of the individual income tax system and not maybe address the trust tax rate system as well, since one kind of mirrors the other. Trusts are a large part of our business, so we'll be keeping a close eye on it. But it should be fun to see how things unfold over the summer and ultimately what direction it goes in.
Okay. Well, following up on that, another area that public officials have been yelling about for quite some time is the Social Security system, and
right.
How we have to have real reform if it's going to remain solvent for future generations. What's your take on that?
Pat, I'm so glad you asked that question, because this is a great segue from taxes. I think most people acknowledge that there is a long-term solvency issue with the Social Security system. Coincidentally, part of that solution, I believe, would have to involve some kind of increase in the payroll tax that supports Social Security. But it would be interesting to see that they would, have some kind of overhaul tax reform and somehow increase taxes on Social Security to shore up the system. So I think that might be a debate that might be left for perhaps the next administration. We'll see what happens. But I think there's some misunderstanding about how it would operate. A lot of our younger clients maintain a rather dubious view of Social Security, that it won't be there when they get older. So what we try and do is educate people a little bit about the process. So Social Security first ran into funding issues back in 1982, 1983. Some amendments were enacted to shore up the system to where it is now. So at the present time, the Old Age Survivors Trust Fund and the Disability Fund have about $2.8 trillion of excess in there. The issue becomes is that as more Americans go on Social Security, the outlays will outstrip the tax revenue that essentially supports those payments. So gradually you'll get this accelerating decline in the trust fund. But what people don't understand is, yes, at some point technically it would be insolvent in that the liabilities would exceed the assets to pay, but that doesn't mean that payments would stop. Essentially what would happen is that the tax receipts collected would just go out to pay benefits. The trust fund would effectively remain at zero. The problem is that unless there's some kind of legislative action, the expected tax revenues would only support roughly 73 to 79% of the promised benefits. So, what we counsel our clients on is, Social Security is not a substitute, but a supplement to your retirement. But even, there are clients where even a reduction of 20, 30% in the benefit would certainly turn what was a very sound financial plan into one that may not be quite as sure.
Okay. The term financial advisor means different things to different people. We alluded to a question earlier that you have to be careful who claims to be an advisor. So could you talk a little bit about your perspective on that?
Right. So that's a great question. I'm sure you guys have a lot of input on the the history of our business. But in my experience, in my view, if I go back, I think if you go back over the decades, the label or term that people would assign to their financial representative was a stockbroker. If you go many decades, and I think over the years that maybe has gotten a bit of a negative connotation, which is a shame in my view. But I think there's been some really interesting developments in our industry that have come to fruition. I think one of them is really the expansion of 401k plans and IRAs. We have much broader participation in the capital markets from the retail investor than we've ever had, thanks to that. I think another element comes from just the kind of explosion in different products and classifications and things people have to pick from. It's very difficult and confusing to try and sort through all the different things that you should invest in. And I think the third thing is really the advent of low-cost computing power, which has really given people in our industry tools to do things and analyze situations far more efficiently and quickly than we ever have before. So I think what's happened is there's been a migration where this kind of traditional, maybe transactional relationship that a stockbroker had, the public has demanded a more comprehensive suite of needs that are really based around an advice type model. So I think if you were to further segment here, just to wrap it up, I think nowadays we kind of look at people as being money managers and wealth managers. I think you can kind of differentiate those two. And a money manager is somebody that really focuses on managing the financial assets, wants to maximize pre-tax returns relative to some kind of benchmark to measure performance. Where a wealth manager, I think, is more comprehensive. In that they deal with the various elements of estate planning, income tax, investments, and insurance, with the goal of creating this comprehensive financial plan that really kind of supports these articulated goals that clients have. So I think for your viewers, really the things they need to ask is, am I working with a money manager or a wealth manager? And then the third thing I think is really the 3 Ps here, which is philosophy, process, and people. And they need to know that the advisor has a well-articulated and credible philosophy, and that there's a good process to execute.
Thank you.
And good people involved.
All right. Well, following along that vein, I really like the money manager versus the wealth manager versus the classic stockbroker. I think that's a very good explanation. Wealth managers are long-term investors. We talked about hanging in there during the bad times. Can you tell our viewers what your tenets are regarding long-term investing?
Yeah, and I think we have a tendency to overcomplicate things. I think long-term investing really kind of rests on 3 simple principles. I think ultimately people have to focus on save, save, save. That's got to be the mantra, because ultimately getting a great return on a small capital base doesn't really get you too much further towards your goals. I can still remember being in my 20s, buying a $5 stock and watching it go to $8 for some of them. That's a great result, but I didn't have any money back then, so it didn't really get me further to my goals. I think the other aspect is the virtue of patience. You know, you can't go out there thinking that your goal is to hit a home run.
Right.
You really have to be patient. The wealth accumulation process is something that happens over time. So you have to adopt that mentality. And I think the third thing is really, you know, true diversification. We tend to see a lot of folks that come in, and to no fault of their own, may own 3 mutual funds that all invest in large cap value stocks.
Right.
So,
same thing 3 times.
Right. So there's no single company that's going to wreak financial havoc on your plan, but you own 3 things that are really exposed in large part to the same economic conditions.
Right.
You know, so that's what we try and preach.
Can you talk for a minute or so, just tell our viewers and listeners if they want to become more literate financially, what are some sources that you would recommend?
You know, and that's something I want to preach to everybody. You know, I'm a father of 2 sons, you know, and what I want to do for them, I think, is teach them life skills. So obviously, the sooner the better. They learn how to cook, do dishes, you know, clean, you know, do the laundry, things like that would be great. But I think, you know, instilling financial literacy in them, teaching them the very basics, you know, that is a life skill. And, you know, when I was in high school, everybody had to take health education and understand that things like smoking and diets high in saturated fat are not good for you, but there was nothing to teach you about good fundamental financial principles.
Right.
So I think what people really need to do is to not be intimidated. There's a lot to know, but not be intimidated and not be afraid to ask questions. And I think just starting with something basic. A lot of people have a 401k plan, which is going to be kind of the workhorse of getting them to their financial goals. So even something as simple as requesting a summary plan document. It's a very concise document that provides all the details about their plan, how it's funded, what the employer contributes. And a lot of these plans will have a call center or maybe a personal representative. I mean, they're there for free, you know, where you can, you know, call them as much as you like and, you know, tap their brain for more information. But it's a good place to start. To be conversant in different financial topics, and, you know, overall just be patient. I think you always have to maintain a natural curiosity for these things, and, you know, down the road you'll be amazed at what you learn.
Well, Eric, we had a lot more questions we wanted to ask you. We're going to have to ask you to come back again, I think, because we just have run out of time basically. So next week, Thad Bench of Benchworks, it's a marketing company, is going to be our guest. And we like to give you some financial insight. We like to talk to you about some good ideas. Marketing is an interesting topic for people who want to get invested. So we hope you'll tune in next week. As far as we're concerned, your money matters.